Michael Blankenship, Managing Partner and Co-Chair of Capital Markets at Winston & Strawn, also host of the SPAC podcast. And Chas Churchwell, to my immediate left here, founder and principal of Churchwell Insurance Agency and host of the DSPAC podcast. So we're going to flip the tables on these guys a little bit today. I'm going to moderate here, and we'll let you guys do most of the talking, but appreciate you guys being here.
Yeah.
Maybe we'll just start off a little bit. Would like to get both your guys' perspectives on the overall SPAC market. Here in 2026, we've seen, what I'd call as a bit of a pickup here. From the last couple years, over 60 IPOs, I think, in the markets. In 2026, there's about 80 S1s on file. I think we've got a couple SPAC listings happening today at NASDAQ as well. So maybe kind of what you guys are seeing in the market and how's that different than other SPAC markets that we've seen recently?
Sure, I'm happy to start. So again, thanks, Derek. Mike Blankenship, as you said, co-chair of the Capital Markets Group. We work with a lot of SPACs and also on the back end with targets. We also do IPOs and direct listings, so the full gamut. But on the SPAC side, we have a little over 200 right now searching for targets, a little over 100 that have announced deals, and a number have closed. There haven't been as many closings as we'd like. It's certainly not 2021 where you had over 600 SPAC IPOs to date. To Derek's point, we've had over 60. There is a lot of SPAC paper out there. I mean, there's a lot of out there searching for high quality and ones out there. But I do see this market as a little different. You have a lot more mature SPAC sponsors, meaning they have a lot more experience. When you put, in 2021, when you had 600 plus out there, a lot of the sponsors may not have had the operator experience or experience as an investor into taking the company public, because the SPAC, to those who don't know, is one of the, the 4 overall ways of taking a company public. And it's been it's been around since the 90s, even going back in the 80s, where you had blank check companies, shells, and then 93 started with the formal SPAC. But fast forward to now, where you have a market where there are a lot of these announcements, and we work on a lot of them. And you'll get into it a little bit about sort of the ones that are the hot areas. But I do see, right now, it's a healthy number. We are starting to see on the IPO front terms starting to come back, where you're overfunding a trust or have shorter terms. So that has happened, where typically a SPAC would be 24 months, and they'd be at a $10 price. So.
Yeah. I would kind of bolt on to what he said, just with talking about the SPACs that are still out there live searching. You've probably got about 50 of those that are legacy deals, to where they're facing down the barrel of a liquidation in the foreseeable future. So I mean, I would go further to say that even though you've got around 200 that are searching, sadly, you've got about 150, I would dare to say, they're probably viably searching, and the other ones are just kind of, unfortunately, limping towards a potential demise. Hopefully they don't, and they're able to find a deal. But interesting also is that when you look at contrasting, as he mentioned, kind of the 2021 bubble versus juxtaposed where we are, what we saw in 25, and even particularly into this first quarter, is as you're looking at DSPAC deals, the DSPAC transactions, we are looking at valuations that are down roughly 20% on deal size. So one thing you'll find is that historically there were these overinflated bad deals, candidly speaking, that you had a lot of bad SPAC deals that happened, which is why it kind of fell out of vogue and had a disdain for a number of years around it. Wasn't disciplined teams. They were like, oh, this IPO or this IP looks really attractive. We'll go ahead and give you $1 billion for that. And all you have is like a clay sculpture of something that you're going to build. And now the teams are saying, no, that's not enough. Now you need to build a team. You need to be getting some revenue. You need to be executing. And even when you're building a team, when you're executing, it's one of those things to where they want to see that there's going to be a valuation that's going to be more disciplined, because I mean, honestly, does it matter if I give you $1 billion today if you're worth $100 million tomorrow? Like so it's kind of just getting more tight on valuations with people and being realistic.
Great, appreciate that. And yeah, Mike, just maybe one point that you brought up as far as overfunding the trust, maybe contracting the SPAC period. There's really when the market does kind of shift in SPACs, there are different levers that can be pulled, from a sponsored team in a economics perspective to make things more attractive.
Yeah, I mean, from warrant coverage on how it looks, whether you have half warrant or you go into use rights, depending on how they look at that. The sponsor, some view rights as the right appropriate approach, and in fact, we're here at NASDAQ. It's a good approach if you have high redemption because those rights actually count towards the round lot holders. So a lot of times when you have a high redemption, it gets hard to pass the listing standards. And so if you are a SPAC with rights, you actually get the benefit of that. But on the other hand, they can be viewed as dilutive to the shareholders, especially the target, its own shareholders. So there are different levers. Overfunding SPAC, you got time duration as well. You got size as well. So just depending on all of that on the front end, it makes a difference. And then on the back end, when you do the de-SPAC, it matters for that target and where it's going to be sitting, what that value will be, what's the merger consideration. As Chaz was mentioning, the valuations is a very important piece. I think the distinction between the SPAC and a traditional IPO is you know the structure, you know the valuation when you're going to announce the deal. Whereas an IPO, you just don't know where that valuation is going to be until the bank's out there doing indication of interest, or they're testing the waters and looking at it. So I think that the SPAC gives a nice route for some emerging companies to get there.
Perfect segue into the next point here. So why SPAC versus IPO? Maybe if you guys want to talk about some of the key differences. Why would a company want to go through a SPAC transaction as opposed to the more traditional IPO route?
I'll say for me, there's really two things that I think. Number one is creativity. The SPAC vehicle, some people think that a SPAC vehicle is intrinsically bad. I don't. I think it's intrinsically creative. I believe it's actually financial art in a way. You have so many ways that you can shape the transaction to where it has the potential to be something beautiful and works for everybody. Which with an IPO, it's more rigid. And so there's not the flexibility to mold things. It's not as malleable. And the other thing is that if you fit in, if you're one of the few companies right now that fit in the mold of a traditional IPO box, do it. Candidly, just do that. But the reality is that unfortunately, there's a lot of companies that think they fit into that box. They go down that path, they file their S1, they file their F1, and then they end up having to flip over to an S4, F4, and go down that path anyway a year later when they find out that investors are just in this current environment that we're in, not interested in deploying capital there in that way. And so I will tell you that it seems to be that, as they talked about in the last one, Anthropic, you got your SpaceX, you've got these big juggernaut companies that are out there that are just killing it. They have fanfare, social sentiment, and massive dollars. And those guys, they're going to do an IPO, and everyone is going to celebrate them. But for the majority of companies going public, the truth of the matter is that in this current ecosystem, I think that a SPAC is really the more viable option.
Yeah, I'd say a SPAC is good for those mid-cap emerging companies. IPOs have a narrow window. When we advise on IPOs, we're always telling whoever's going down that, you're going to wear two hats. You're going to run the business, you're going to do the IPO track and working with banks to get that value. But you always have to be ready for a market window. With a SPAC, you don't have necessarily that market window that you have to worry about whether it's pricing right at that time, because you can come out and do it. I will say the best companies are those that have, in that emerging side, that they do have a great growth story. Just like an IPO, you need to tell a great story about what you're doing and why investors should pay attention to you. The best are ones that are in those industries where they're the hottest right now, where retail can come in. So a lot of times on the IPO, you have a lot of ARBs and hedge funds come in for the return that they're going to get and have that money in trust, and then have the option on the back end to redeem, but keep a warrant. Whereas if you have a de-SPAC and you have the right kind of mix and the right story, maybe you can get retail to kind of come in and mix in there, and so that you have a lower redemption kind of going forward. And I think that can really help if you're, because look, IPOs are great and certainly want to make them great again, but you could also see the valuations drop quickly too. So you only have so much time, post public to show that you have great story. And I think with SPAC, with that announcement, maybe you have the ability to tell that story because the SPAC is already a public company. So you have all this press release IR story that are coming out as you're going to complete. I'll also say the SEC has changed. So the previous administration, 2021 to 2024, they were very difficult to get some of these. And they were very academic on a lot of the comments, right? And then they came out with their proposed rules, which really changed the market. You went from 600 in 2021 to 80. And part of that was the SEC came out in 2022 with the warrant, change in warrants liability, as you all know well at Century, but going to, that spooked it. And then you had them come out with proposed rules, which were later adopted in July of 2024. That changed the way that it operated, but now we have an SEC staff that is looking at them. But I do think you're starting to see a lot of these clear a lot faster, and so hopefully it's a whole better story to get to market, and that people are self-policing, self-regulating with those comments and getting it done. Because they still need to tell a story, and you still have litigators out there that if you're wrong, you're going to get sued. So you have to be very cautious on that, and I think that is something critical to think about as well.
Sure, and in telling the story, that's a big part of the whole transaction, whether it's a SPAC transaction or any other capital markets type transaction, and we'll get to that a little bit more here shortly. But we talked a little bit about types of companies, why a SPAC transaction makes sense. What about cross-border transactions? Are you guys seeing an increase in the foreign companies looking to access the U.S. markets and through SPACs?
Yeah, look, we had one that closed, this quantum computing company out of Canada. Cross-border, was dual listed. That closed 2 weeks ago. And then we announced another quantum computing that's out of Switzerland. So a lot of those are coming out. And I think part of that is they know that the structure that's going to come as it's announced, because it's going to be hopefully tax-free reorg for the SPAC shareholders and then for its own shareholders. So I think the SPAC allows to think about that cross-border. They think about it as more of a traditional M&A deal. So it's more of a, we're going to do this deal and we're going to think about the best way to structure it cross-border. And that's important for non-U.S. Companies because they don't know coming in the United States. I mean, the NASDAQ and NYSE, early on there was a pause on companies coming out of China and others because of VIEs and other kind of structures. And so now you have kind of hopefully defined structures that help a lot of these cross-border companies come in, because it may be difficult for them to come in as a foreign private issuer and do an IPO to tell their story, as opposed to going through a SPAC story and being able to come out with $1 billion valuation. That's a true $1 billion valuation versus doing an IPO, which may not get the uplift that they need for that valuation.
Sure.
So I would add on to that the fact that a lot of people don't know that they came out with Homeland Security, worked with SEC, and they created this cross-border task force last year. Candidly speaking, the SEC said we're kind of frustrated with the APAC region and with the fact that we keep having all of these deals to where they come, get capital here, and then things just flounder. And they said we need to start being more stringent. We need to be checking them more, and there's going to be greater scrutiny on everything. And then also they were out of that trying to say we're going to put a target on anybody that is in Malaysia, Singapore, Hong Kong, and PRC, basically saying, hey, look, because we think that all of you guys are probably flowing PRC money through you, we're going to put you under a microscope, and not just you. Even if you are using a lot of these APAC service providers, if your legal counsel, your audit, accounting firm, things like that, it's adding this increased level of scrutiny and slowing everything down even further. And then, of course, you'll find that you guys may, and some of you may know, there was a massive class action litigation suit that just came out recently against roughly, I think 101 companies were named in it. Almost all of them were foreign filers, and 29 investment banks. A bunch of my clients. I had a really busy week about 2 weeks ago with claims as a D&O guy. But basically, it's one of those things to where there is this massive scrutiny, not just from regulators, but also litigation. But interestingly, out of that 101 companies, not one of them was a de-SPAC transaction. So I would say that.
Interesting. Let's maybe stay on the topic here of risk, and Chaz, you deal in risk every single day. SPAC transaction, any capital markets transaction for that matter, there's always some level of risk, execution risk. What are some of the things that either target companies or SPAC sponsor teams can do to help de-risk the transaction?
Yeah. So one thing I would say is that in 2021, there were 36 securities class action litigations against SPAC, de-SPAC transactions. And in 2025, there was 5. You'll find it fell off exponentially. A good tranche of that is going to be attributed to the fact that there is a delayed onset whenever a de-SPAC happens, traditionally speaking, before you end up with the securities litigation. But what you'll find is that also we have found ourselves in a more agreeable SEC right now with SPACs, that they're not putting the screws to them. And when attorneys that are these plaintiff law firms, they love whenever they find themselves in a position to where the regulators just kind of give them a layup, because they're like, oh yeah, hey, the regulator's already accusing you of this or investigating you for this, so now we're going to go ahead and launch it. I mean, it's like they're giving it to like the Rosen firm or whatever that's out there, So essentially what you'll find is that even though the amount of securities class action litigation filings are down, the dollars that are being spent per event are up exponentially. And so what you'll find is that that what we're seeing at the moment is that you may incur fewer events, but whenever that happens, everybody, I mean, if you think that attorneys are cheap, raise your hand. It's legal defense. I mean,
we're worth it.
You're worth it, baby. No, but the reality is that legal defense is remarkably expensive. I've got a client that just wrapped up 4 simultaneous lawsuits. They got sued in 4 courts for one event, and they ended up and they got a dismissal on 3 out of 4, but it was $7.5 million, and they did nothing wrong. These guys did nothing. Somebody posted about them on Reddit, and their stock went from $2 to 54, and then came tumbling down. And because of that, they ended up in 4 securities litigation events. So like $7.5 million just to deal with it, to get to a dismissal, and on the one that they cleared it, they settled for like $1.25 million. So I mean, $8.75 million when they did nothing wrong. It doesn't matter if you're wrong. If you can be a clean shop and you can still get sued. In fact, my final thing, and I'll turn it over to my brother here, is that interestingly, something we saw that was pretty prolific last year from a D&O standpoint. 26% of all securities litigation that happened last year, the plaintiff law firm withdrew the filing 26% of the time before it even got to a dismissal. They basically went, did discovery, see if they could find a string that they could pull, and when they realized that they couldn't, they went ahead and withdrew it. All the while, the company still had to go out, spend $1 million, get legal counsel, whatever. So, and then at that point, you probably haven't even hit your self-insured retention, so you just blew $1 million for nothing. So.
Yeah, I would say on the risk, at least being a lawyer here, that having disclosure, you need to make sure it's correct, because under securities laws and part of these litigations, that it's a strict liability, and there are plaintiffs firms that will see that. So I think from a SPAC perspective, you're usually not going to come in and sue the SPAC sponsors, because really what's the damage there? What, and especially if there's high redemptions. I mean, if you come down to a couple $1 million left, I mean, what's your damage? You had the chance to get out before the deal closed. But I will say, from a risk perspective, it is about disclosures. The SEC no longer allows you to have the projections, or at least use forward-looking statements to have those projections that go out. Back in 2021 till they were adopted in 2024, you would often see some of these that had 5, 10-year projections, particularly when the electric vehicle EV were popular among SPACs. And so you would see these hockey stick projections, and that does create a lot of risk because you come out, and at the time, SPACs didn't have that liability, but now they would. So now they're very cautious about that. So as long as you're cautious about what you say, that is a very important piece. And then every statement you say in there should be backed up. The difference between the U.S. and a jurisdiction like Hong Kong, in Hong Kong, there's no private plaintiff's bar. So every statement you make in that, the securities regulator backs that statement up. And I think the same way you kind of have to view when you have your S4, F4 from a SPAC or an S1, F1, those statements need to be true, and there's no material misstatement or omission among those. And so I think that's the biggest thing you could do, is to make sure you have all the material information out there and you're telling what you're going to tell, and don't oversell the business. I know it's something you want to do. Every company wants to say they're worth 10x than the valuation that they're first told. But I think that instinct needs to come down a little bit and realize that just build that story, tell that story, and tell it the right way with the truth, and you won't necessarily find these litigations. Stock drop suits happen, unfortunately, and that's why you have insurance. And so, but again, from a legal perspective, it's all about the right disclosure and working on that, because we see all different stuff. I mean, I work on tons of deals right now on the de-SPAC side with and then on IPOs too. But I think the biggest point is that making sure you have support for everything you're doing.
Yeah, disclosure, material, making sure you don't have material misstatements, all very important. Yeah. From both from on the SPAC side as well as the operating company side, capital markets readiness is super important. For a SPAC, SPAC is still a public company, right? So you've still got to adhere to all the accounting and reporting regulations. If you get your accounting for warrants wrong, you got to restate your financial statements. You have, material. You can get material weaknesses and controls on a SPAC, and those could potentially carry through to operating companies as well. So, making sure you've got that readiness. Function.
If I could add one thing to that.
Sure.
A lot of times companies, if you're a private company that's here and you're looking at doing a deal to go public through a SPAC vehicle, one of the most common misconceptions is that you don't have exposure until you're public. So, but here's the problem: is as soon as you have your S4 filing, as soon as you are publicly out there in the Edgar world, then you have an enhanced exposure. And so you should have private D&O insurance in place before there's ever a public filing that says your name. So that's one thing that I would caution everyone on. Just wanted to add that in there. Sorry.
No worries. Appreciate it.
But you do get every filing, public filing, I get a letter from a law firm about some disclosure piece from plaintiffs, and usually it's ignored, but they're looking for a mootness fee. They're looking for a fee to moot, but people are paying attention. It happens.
Happens.
He's right. I mean, it's the high risk there.
So now that we've talked about kind of ways to de-risk the transaction a little bit, maybe Mike, I'll start with you. Maybe one or two things that can help get the deal done. Maybe it's supplemental financing arrangements. Anything from a legal or regulatory perspective. Any thoughts there?
Yeah, I think finance is important. If you can go out and you can get financing at the time of announcement, it will help validate that valuation that's coming out. Plus, you'll have cash coming out at the end in case there's a high redemptions, which is a feature in pretty much all SPACs now, unless the stock's trading above and you have that good story in the right industry. Right. So I think having that and trying to find the best way, and maybe work with an investment bank or a financial advisor to get you into that, depending on the industry. I know we talked about it. I'll quickly talk about sort of the hotter areas right now is, I call it energy adjacent companies. So AI, data centers, anything around that is something that we're seeing a lot more. Life sciences, all the stuff that they kind of talked about. Space will be one. So you've got these areas where that could potentially find a lot of financing early on, which will help validate the deal. So that will sort of de-risk at least the money that you need coming out, the capital you need coming out. Talk about disclosures. That's another piece that's going to de-risk it. And then timing, making sure, like while there's no IPO window, just making sure you're all aligned as a team. So what the cadence usually is, you enter into your SPAC, you enter into an LOI with Target. If you're the target, you work with them to get a business combination agreement done. Maybe that takes a few weeks. You sign the business combination agreement. Hopefully, you get financing within that time frame. Announce it, and then at the same time, or a few weeks later, you're hopeful that the target has its PCAOB audited financials ready, so that you can file that with the SEC, and then the SEC process takes hold, and that's the 1 month for the first one, and then every iteration after that's a few weeks. Making sure you understand the timing will help you de-risk too, because your team could be patient. Again, if the target and the SPAC teams are working well together and getting it done, you can get it done fast. I was just here a week ago ringing the bell for Greenland Energy. We closed them within, announced in October and closed in March. So I think
That's really good, by the way.
so having that kind
More
of
months
time
with these
frame is something that we're starting to see a lot more. And if you can work in tandem and get it done and focus on the financials and work with the accounting and everybody, it will work out well. If there's infighting, if there's no way to get this something, it can last over a year, and it's a painful process.
It is, and it takes a village of advisors to kind of guide both the SPACs and the operating companies through that transaction. And the more they're working in lockstep, the quicker and the more successful things go. Any last thoughts?
Any last thoughts on that one?
What's it take to close a successful deal?
I honestly think that I think more than anything, it really just comes down to having a solid team that's putting in solid work. If you've got the biggest hang up to his point to where things can get drawn out a year, I will see these teams to where they've got this guy on their squad who he's kind of that black hat to where he's supposed to be the one that questions everything. But if you've got the black hat running the deal, then it just makes everything a nightmare. The SPAC team ends up begrudging you for it, ultimately because you're paying for a lot of the back end expenditures. All you're doing is costing yourself more money. And I would say making sure that you've got the right point people from your team quarterbacking, not only as legal counsel, investment banking, but within your own house. I really feel that that's one of the big variables. Also, valuation. Just coming from a D&O perspective, I will tell you the two biggest areas to where your risk profile is there once you de-SPAC and you're public. It's public readiness, which means that, just like they were talking about in the last panel, making sure that you've got solid IR, making sure that you have a proper attitude of what it is to be a public company. You're taking public money. Get in the public. There's 6,400 companies and nobody owes you a thing. Candidly speaking, nobody owes you anything. You're out there competing against 6,400 companies. The average fund team is going to have about 200 companies on their book. The average personal E-Trade account has about 18. So you're competing against 6,400 people or 6,400 teams for their dollars. Make sure that you are out there putting yourself in front of the masses to get dollars. And then the final thing I would really say is execute. As soon as you de-SPAC, you should have a plan for the first 12 months for measurables that you know that you can go and quarterly, you can say, we're going to do this. And then 3 months later, we did it. 3 months later, we did it. 3 months later, we did it. You're already fighting an uphill battle coming out of your de-SPAC on so many variables and pressures that are against you. But if you can weather the storm and you can execute and you can deliver and deliver and deliver, those are the variables. These guys know this. I'm actually building a SPAC that's about to IPO here very short. For us, the number one variable that we want is a team that's ready to execute. And that's it for us. Like, maybe it's the fact that I'm prior Army, but I'm just kind of a no shenanigans kind of guy. I want discipline and executing strategy with a team. So that's it for me.
That's it. Yeah. Preparation and execution creates value, right? And
Yeah.
that's what investors and shareholders are looking
High
for.
quality
quality.
investors want. So.
That's right.
Yeah.
Great. Chaz, Mike, appreciate your insights today.
Come on, we finished it on time.
All right,
I like
right
it.
on
Right as
time.
the clock expired.
Thank you.